All right, guys, so today we are going to talk through fiscal and monetary policy and make sure you guys understand how this works. So, looking at fiscal policy first, fiscal policy is controlled by the federal government, specifically Congress. So, the president can make suggestions, but really Congress is going to be controlling the government's response to the economy. There are two tools the government can use, and those are going to be government spending and taxes. And it's important to understand that they can use expansionary or contractionary policy. So the way this works, if we look at taxes, the government can lower taxes or they can raise taxes. So if they lower taxes, this is considered expansionary, because if they lower taxes, you and I have more money on our paycheck, and we all know that more money means more spending, and that expands the economy. If they raise taxes, we will have less money in our paycheck, so we'll spend less money, and that's considered contractionary. Government spending works the same way. We know that government spending is directly tied to GDP, right? That's our C plus I plus G. Okay, so if they increase government spending, they're spending more money, which expands the economy. If they decrease government spending, they'll contract the economy. There'll be less money going around. So these are the only two options the government has. So lowering taxes and increasing government spending is expansionary policy. Raising taxes and decreasing government spending is contractionary policy. It's important to understand that when they use the expansionary or contractionary policy, we should see both of these things happening during that time period. All right, just another little note you need. We know that the government gets its money from taxes. However, it's important to understand that sometimes the government, sometimes the government does not have enough money in its taxes. So they have to borrow money. They take out a loan just like a business. And when the government spends more money than it has, we call this deficit spending, DEFICIT. They have a deficit. So every year the government pretty much has deficit spending. However, if you hear the term national debt is all of the deficits added up year after year after year. Okay, so fiscal policy is pretty straightforward. The government can change taxes and change spending, and that is it. Right? Monetary policy is where it gets a little more complicated. Okay, so for monetary policy, this is going to be controlled by the Federal Reserve, which we call the Fed. It's important to understand the Federal Reserve is a private entity, is an independent organization. It is not the government. They're completely separate, right? We don't want politics interfering with how our economy runs. Okay, the Fed has 4 tools that it can use to help manage the economy. And remember when we talked about how unemployment and inflation are kind of on a seesaw, the Fed uses these tools to balance the seesaw, because we really don't want inflation going too far past 2%, and we don't want employment going above that 2 to 5% range. Okay, so the first tool is open market operations, or OMOs. This is buying and selling of government bonds. So this is to directly control how much money is in the economy. So buy big, sell small. So what they'll do is they'll buy bonds from people. So a bond is kind of like having an IOU kind of gift certificate sort of thing. So when they buy the bond, they are essentially giving people money and taking the bond back. Or when they sell a bond, they're giving you the kind of IOU in a few years and taking your money out of the economy. So when we talked about how circular flow is kind of like a rubber band growing and shrinking, buying and selling bonds is how the Federal Reserve controls literally how much cash is going around in the economy, right? So open market operations is directly changing the size of that rubber band that we talked about. Okay. Next is the reserve requirement. So what this does is essentially says banks have to keep a certain percent of all deposits. So during the Great Depression, we know that when the economy got really bad, people freaked out and they went to the bank to get their money. We talked about bank runs. And when they got there, the bank was like, sorry, we don't have any money for you because we loaned it all out. So the reserve requirement prevents that from happening. So the Fed might say that a bank has to keep 10% of all their deposits. And this guarantees that they have money in hand. So as the economy is shifting, the bank or the Federal Reserve might change that percentage for the bank. It might go up to 12% or 15%, or it might go down to 8%. And this is really going to influence the amount of money banks have available to loan out, right? So when we talk about like banks having money in their vault, part of that is the reserve requirement. They are required to keep a certain percentage in there. Also note that for that percentage, it's not like every single bank branch, it's the bank as a whole. So if we say the reserve requirement is 10%, that doesn't mean every single Wells Fargo keeps 10%. It means the Wells Fargo Corporation as a whole keeps 10%. All right. Next is the discount rate and the federal funds rate. These are very similar. Every now and then, a bank needs money. Okay, so a lot of that ties into this reserve requirement. If the Fed makes a change and a bank has loaned out too much money, it needs to add more money to keep this percent at whatever the Fed says the percent has to be. So occasionally a bank will have to borrow money. So the first thing a bank should do is try to borrow from another bank. And if they do that, they have to pay interest rate because they are taking a loan from another bank. And that is what we call the federal funds rate. So the Federal Reserve controls the interest rate if a bank borrows from another bank. As you saw on the stations, the Fed is the lender of last resort. So if a bank has loaned out too much money and it can't get a loan from another bank, then it has to go to the Fed, right? This is worst case scenario, like, we did something really bad. We need mom and dad to bail us out. So a bank can borrow from the Fed if it is like a dire, horrible situation. It doesn't happen very often, in which case the interest rate they pay is what we call the discount rate, right? There's no discount. It's not a pretty number, but it is called the discount rate. So number 3 and number 4, the discount rate and the federal funds rate, control the interest rates in our economy. So like last week with everything going on with coronavirus, the Fed announced that they were dropping the interest rate to close to 0. So that means that it's going to be a lot cheaper for loans. So we might see banks borrowing money to give out more loans to people. I kind of ran out of room here, so I did the rest of the notes on the back. So when we look at the actual tools in response to fiscal and monetary policy, 4 tools here. So we talked about open market operations. That's buying and selling of bonds. So for here, if the Fed wants to use expansionary policy, they're going to buy bonds, buy big or sell small, right? So they contract, they're going to sell. For the reserve requirement, that's supposed to be required reserves, all right? They will lower the reserve requirement. So they might go from 12% to 10%. Or if they're using contractionary, they will raise the reserve requirement. And then same with the discount rate and the federal funds rate. If they want to expand the economy, they're going to drop those interest rates, which will encourage loans. If they want to contract the economy, they will increase the interest rates, which will discourage loans. Okay, so kind of a bigger picture here. Let's see if we can do this. So when we buy and sell bonds, that's controlling the actual money supply in the economy. When we change the reserve requirement, they are changing how much money is available for loans. And when they change the discount rate and the federal funds rate, that's going to influence the cost of loans. So these notes over here might be helpful in understanding why they use these different tools. So buying and selling bonds is the most common. It's the easy way to just change how much money is floating in the economy. So this is what we're going to see used the most often. Seeing these other 3 things change is only when they're really worried that something more extreme is going on with the economy. So this is the quick fix. This is the first tool we'll see. And then we see these other ones when there are bigger concerns. So right now we know with coronavirus, they're really worried about hitting a recession. So right now we're in expansionary policy where they're dropping these rates, trying to encourage people to keep spending even though we're all kind of stuck at home. Okay, hopefully that helps. Please message us if you have any questions.